Good morning, everybody. Thank you so much for coming. We're at the end of the semester. I know that at least many of us whose lives revolve around the academic calendar are feeling especially enthused at the moment. So I thank you for taking time out of your schedule to come today. Ian is going to present the five-year model update along with a lot of associated information in a moment. So let me just say that we just heard a version of the presentation in joint planning and budget, and we had a very spirited conversation, so I look forward to continuing that conversation here. Thank you.
Thank you, Elliot. Good morning, everyone. Thank you for coming. Thank you for allowing me the opportunity to present the five-year model at the Budget Town Hall. As Elliot said, we did have a good conversation at JPBC, spirited in a positive way, I should add, not necessarily in a negative way, but it was very good, and I do encourage any questions you may have. Happy to take them as I go through the material or at the end. Happy to do either way. Okay, so without further ado, so let me just walk you through the agenda in terms of what we'll cover in the next period of time that we have together. I will just do a very brief overview of the whole five-year model, put some things into perspective. Then we'll do a little bit of a deeper dive around some of the key elements, particularly around enrollment and retention. Very important, very key. And then we'll go into the five-year model itself. We'll take a look at the financials. We'll go through some of the investments that we've decided to make and explain why we've had that opportunity to make those investments. And then we'll take a look at what I would call the key indicators, certainly from a financial perspective in terms of the overall health of the university. And that's looking at our reserve balances and looking at our structural deficit. We are running at a structural deficit, and I'll explain why that is the case. And then we'll touch briefly on some capital project updates and then Q&A at the end of this session. Okay, so the overview. A lot of the format that I'm going to show in this presentation is very similar to the format that I showed when we had the session back in November. So there's a degree of continuity there, which I think helps certainly in terms of the understanding. And at that session, I did reinforce the importance and the emphasis around enrollment and retention. And it truly is fundamental to the overall long-term health of the university. It also drives our reputation. It drives our reputation within the SUNY comprehensive system, but also within the region that we operate and we support. And it helps to drive our overall income or our revenue. So the amount of income that comes into the university that allows us to do various things that we would like to do, just to keep the university running, but also to be able to make some investments. So very, very important. If there's one thing I'd ask you to take away from this conversation, it is to focus around enrollment and retention. And we are making some good progress. There are some favorable trends. But it is, in all fairness, I wouldn't say it's getting harder, but it's perhaps becoming a little bit more challenging. We've led the pack, I would say, over the last couple of years, particularly within the comprehensives. And there are a number of institutions that are now probably nipping at our heels. So the good thing is that we're aware of it. And that we are now starting to have those conversations around what do we need to do to maintain our advantage, and we can touch on some of those. Having said all that, we obviously must continue to exercise fiscal responsibility. By doing so, that enables us to have more flexibility. So we have greater focus around our costs and how we manage those. It then enables us to make some investments, appropriate investments to support the university, and we'll share some of those as I go through this presentation. The five-year model itself has been developed on a business-as-usual basis. There's a lot of noise, there's a lot of rhetoric, there's a lot of speculation going on outside in terms of what may or may not happen in the educational field. From a planning perspective, I can only predict based upon what I know. As I say, there's rhetoric, but there's no clear guidance and or clear indication of what may happen or may not happen. So the JPBC meeting, a question was asked about, does this budget include anything in relation to tariffs? It does not. I don't have anything about the I don't have any firm indications around what tariffs could do. I have some anecdotal evidence, but not necessarily relating to this institute, but to others. But we haven't at this point built anything into this model. And as we go through it, you will see that our forecast accuracy is pretty good. And that's important because if we're accurate in terms of our forecasting, that gives us greater ability and greater confidence to be able to make decisions from a financial standpoint and understand whether they are affordable and what the impact is likely to be or will be upon the overall health of the university from a financial standpoint. So to me, that's important. And then we would just share some of the improvements of what I would call the key indicators, and I alluded to these a little bit earlier, our reserve balance and our structural deficit. Yes, we do operate at a structural deficit, and as I said, I'll explain why, and I'll show the dynamics that leads us to that. But overall, against those two metrics, reserves and structural deficit, when you see the charts, I think we're doing okay. We're doing a pretty good job against those. And then capital projects. This continues to be something that we need to manage, and we need to pivot. We need to shift from, and we are shifting more to a proactive than a reactive approach. But things will get thrown at us, things that we aren't expecting. And so we have to pivot, and we may have to reprioritize. You know, we do have a prioritization process in place. We have a 5-year capital model, that project timeline that we review. We review it with Cabinet on a quarterly basis, and we also review it with SUNY. But we have to be aware that we have far more demand than we have in terms of supply of funds. But we'll touch on that in a little bit more detail later on. So, moving on, let's spend some time now and talk about enrollment and retention. So it's a busy slide, so let me just orientate you through the slide. If we take a look at the graphic on the top left-hand side, this shows total full enrollment since 2019. And so I've graphed that out. Then there's two lines. The blue line is our current prediction. The red line was the prediction or the forecast that I shared back in November. So let's take a couple of years. Let's look at 2024. Now, when we originally set our target for 2024, we set a target of 7,143 students to be enrolled fall of 2024. We hit a number of just close to 7,500. 7,482 was the number that we finally shook out at. That was a significant improvement. And that improvement gave us a lot more flexibility and in part helped us to make the decisions around the investments that we have decided to make that I can share with you later on. So very strong performance. Now, if we look at 2025, we're predicting that that enrollment number will be 7,751. So 7,751. That's 150 students higher than what we thought in November of last year. So another good sign that we're moving on a good forward trajectory. If you look at that in terms of growth, and you look at the growth since 2022, we've grown our enrollment by 21%. And if we just look at if we look at 25 predicted over 24, that growth is 3.6%. They're pretty solid performances in terms of our enrollment. Now, I'll touch on when we talk about undergraduate that we are seeing some challenges, particularly from behaviors from other institutions, most notably University of Buffalo, in terms of some of the approaches that they are taking. And as I said earlier on, we're aware of that, and now we're starting to plan for that accordingly. But it is something that we are keeping an eye on. Just as a factoid, just to put some of these things into perspective and the importance, if I look at the enrollment, and if we were to enroll an additional 150 students, just in pure base tuition, so doesn't include dining services, does not include accommodation, 150 students will add $1 million of income per academic year. So over a 4-year program, that's $4 million of additional income that comes in by growing our enrollment by 150 students. That's important, and I'll come back to that because when we start to talk about revenue, I'll make some reference to something called P times Q, the price times the quantity. Doesn't matter what business you're in, revenue is a function of the pricing that you can obtain and the number of items that you can cell, or in our case, number of students we can attract into the institution. If you look at the blue line and then compare it to where we were looking at back in November, we get to basically the same point, which is a full enrollment in 2028 of 7,880, but we get there in a slightly different way. So back in November, we saw more of a kind of sequential growth. This time around, we're seeing a bump in 2025, and I'll give you a little bit of an indication on a subsequent chart in terms of how we're shaping up against that target. And then we see beyond that more of a moderating impact. So we're seeing more of a 0.5 point to a 1% growth in terms of enrollment, 26 outwards. I think that's a sensible approach to take, just given some of the dynamics I alluded to on earlier in terms of how some of the other institutions are snapping at our heels from an enrollment standpoint. I would be amiss if I didn't at this point say thank you and a tremendous effort from everybody, but particularly from Sarah's team and Robert and the enrollment and the recruitment folks. This is getting or requires a lot of professionalism, hard work, dedication and commitment to get students to come to look at Brockport, to get students to enroll in Brockport, and then as we go through the retention numbers on the bottom of this chart, how we all have a part to play in ensuring that that experience when a student walks through the door is second to none. They want to come back. They want to then recommend us to all their friends and their colleagues, etc. And you get a snowballing impact. So kudos to Sarah, Robert and the team for getting everyone through the door. Now the onus is on all of us to make sure once they're in the door, they stay in the door. So with that, let's talk a little bit about retention rates. So if you look at the graphic on the left-hand side at the bottom of the chart, again, over time, this tracks out the retention rates. And what I've done, each of the color coding shows you a different dynamic of what we look at when it comes to retention rates. So for example, if I can see the colors correctly, if you see the, let's take the green line, that shows other returning undergraduates, for example, and we can see the performance there over time from a retention standpoint. And we look at transfers, we look at other returning graduates, we look at continuing freshmen. And let's look at this in two chunks. Let's look at this from 2022 to 2024. And if you take a look at it across all of those dynamics, or all of those elements, those hydraulics, if you will, with the exception of continuing freshmen, each one was improving. Continuing freshmen dipped a little bit in 24 over 23. But we are projecting that they will return back to a positive growth trajectory in terms of retention. And then when you look at 25 beyond, pretty much all of them are staying stable or are starting to improve slightly. Again, just to put this into a context, if you look at a 1 point improvement in retention across all of these elements, so retention overall for the university goes up by 1 point, that will deliver or have an impact of retaining an additional 75 students. 150 students, $4 million of income over 4 years, 75 will be 2 million over 4 years. You recruit an extra 150, you retain another 75, then you start to see the compounding impact it has in terms of income coming through the door. One thing of note, and we'll touch on this a little bit later on, when you look at new graduates, the new graduates is projected to perform particularly well as we go into the out years. So that's enrollment and retention at a high level. Let's then kind of double click down and take a look at enrollment and the hydraulics or the dynamics from a undergraduate standpoint and from a graduate enrollment standpoint. As the chart says, the top graphic on the left-hand side shows us again the trend of undergraduate enrollment. Same format as the previous chart, so the blue line is our current projection, the red line is our previous projection that we had in November. So if you look at 2025, we're projecting just over 6,000 undergraduates. That will be a 3% growth over the prior year. And it'll also be the highest number that in absolute terms that we've actually achieved since 2021. And that 6,011 is 160 higher than what we were projecting back in November. So moving in the right direction. Takes a lot of hard work. We also have people that are nipping at our heels, University of Buffalo, for example, who are being very aggressive in the way that they are admitting students, particularly from a GPA standpoint. So it's something we need to keep an eye on and react to, which we will. So how are we doing against this 2025 view? The team looks at this almost on a daily basis in terms of where are we with first year deposits. And even this data now is somewhat dated because it's a snapshot as at May 1st. But at May 1st, first year deposits were at 1,302. 60 up compared to 2023. So why are we comparing against 2023 and not 2024? 2024 was a little bit of an oddity in the sense that we had some of the challenges with FASA and we extended the first year deposit deadline. So to really do a true apples to apples compare, we need to go back to 2023. As an example of how competitive this space is, if you'd spoken to the team probably 2 or 3 weeks ago, they weren't feeling as confident as these numbers would suggest that we should be feeling. So it changes on a daily basis. The other dynamic I would say is that we have this phenomenon called double deposits. So you'll have students that will be depositing at multiple universities, or at least 2 universities. And as at this date, or roughly now, I think we have like 29 or maybe 30 in that ballpark of students that have deposited at SUNY Brockport and have deposited at other institutions as well. Some of them are SUNY, some of them aren't. So that's another population that the team has to work with to convince those individuals that Brockport is the place to come to. Transfers, and we'll talk about transfers a little bit later on, but this is another good indicator. We're at 394 transfers, that's up 85 compared to 2023. So overall, we've had a good trend of performance in undergraduate enrollment. We have a more competitive landscape that we're having to navigate through. The positive thing is that we're aware of that, and we're spending time, Sarah and the team are spending time trying to figure out what the best approach is to make sure we stay ahead of the pack. Far better to be doing that now than when we suddenly look over our shoulder and everybody's gone rolling past us. And we have, at this point, some good indicators that we're on the right trajectory. So that's the undergraduate enrollment. Let's shift gears and talk about the graduate. And as you can see, the graphic on the bottom left-hand side shows the graduate enrollment. Same structure since 2019. Blue line is the current view. Red line, it was the view we had in November. And they're pretty much aligned. There's a little bit of difference, but I'll just call it noise, to be perfectly honest. So we're looking at graduate enrollment of being about 1740 versus 1750 is what we had in November. But that 1740 is still a 4% growth over what we had from the previous year. And when you look at where we project to be by 2028, we're in that same space. We're at about 2,000 students. We have the highest graduate population in the SUNY Comprehensives. It's something we should be incredibly proud of, and everyone that's played a part in that, they should feel incredibly proud as well. To put it into a different kind of context, if you look at the growth, and if you look at the growth since 2022 to 2025, that is a 32% growth. That's phenomenal. If you look at the target we're shooting for by 2028, and when we get there, not if, when we get there, and we get to that 2,000 number, over that same start point, 2022, that will be a 58% growth. Quite remarkable. So the next chart is an eye chart. People either resonate with the visual pictures or people like the detailed numbers. So I've kind of put both up there. And I've called this hydraulics because what it does is it starts to break down by each of the category, undergraduate and graduate, the way that we look at the component elements that delivers, for example, that undergraduate enrollment number. Number of new freshmen, number of transfers coming in, and we'll talk about transfers in a second. The number of undergraduates that are coming back and continuing, direct linkage to retention, which is why retention is so important. So when we look at those trends, and let's just talk about transfers for a second. If we go back and we look at the transfers since 2020, well, actually from 2022, because 2020 is probably a little bit tricky, but if we go from 2022, and we had 579, then we went to 726, and we went to 764. Transfers has been a strength for us, and we believe it will continue to be a strength. Now you can see that it dips a little bit to 725. When we had our first conversations around the forecast, that number was at 700. But we were seeing indicators that made us feel confident that we could take that 700 to 725. Equally, when we looked at the new freshman at 1250, when we did our original modelling, we had that number at 1200. We were seeing enough information that we were comfortable to take that to 1250. And then when you look at the out years in the undergraduates, we're moderating a little bit. I think we're being cautious but sensible in terms of using these numbers for our enrollment forecasts. And all of these numbers form the basis of our 5-year model, so there's clear connectivity there. So I look at the undergraduate numbers and I acknowledge that we're in a tougher environment. The other half of me looks at the trend and says, okay, maybe there's some opportunity. Maybe there is, maybe there isn't. I don't know. I think it would be unwise to predict that that opportunity wouldn't materialize, just given some of the things that we're experiencing and starting to see. So to me, this is a very pragmatic and a very sensible outlook to take. If we look at the graduates, again, you can see the trend in terms of the graduate population. We should feel very good about the way that our graduate programs are being accepted and are being a great support to our overall enrollment performance. So that's enrollment, that's retention. So what does that all mean financially? How does this all kind of fit together? So, bear with me, a lot of numbers, complicated chart. This shows the 5-year model. Numbers are at the top, so let me just talk you through and orientate you through this chart. What I've shown on here are the key indicators, at least from my perspective, in terms of keeping an eye on the overall health of the university from a financial standpoint. So if I take a look at 2024, and let me just walk you through that so it's you can understand what we're showing here on the page. I start with reserve balances. So this is the amount of reserves that we have at our disposal at the university to make decisions. How do we want to use those reserves? That reserve balance is impacted by structural deficit and then what we would call temporary adjustments. So if you see on the chart, you have A plus B plus C equals the reserve balance. So in 24, I have a reserve balance of 26 million. We predicted a structural deficit of 3, so that would take the reserve balance down to 23. Then I have that temporary adjustments of, call it a rounded 2, brings me back up to a rounded 25. And then that 24.82 rolls forward as my opening balance in the next year. The math stays the same and it rolls all the way forward. So let's do a little bit of a deeper dive in some of these items here on the chart. So let's talk about revenue. Earlier on I said revenue is a function of price times quantity. We don't have the ability to take up our tuition fees. That's a decision that's made at SUNY. It's out of our hands. I don't think there's an appetite to increase tuition fees. I get it, fully understand it. But that's one element of that formula that drives revenue. So now I know that my price point is going to be fixed for the duration of this model. So my only other variable that I can use to increase the amount of income that comes into the university is the number of students that come in and retain, which is why the enrollment and the retention is so important. So P times Q. If we look at revenue and we look at the growth, so I focus on the growth line. So in 2024, we have revenue growth of 9% or 8.8% year over year. That's purely driven by the phenomenal enrollment performance that we had in 2024. If you roll into 2025, we're projecting a 2% revenue growth. Again, it's driven by those strong enrollment numbers. Then if you remember when we looked at the enrollment numbers going forward, they were kind of plateauing out a little bit. Small growth, 0.5 point. That's why when you look at the revenue line, you're seeing small revenue growths. Again, linkage to the enrollment number. When you look at the makeup of our revenue, about 2/3 of it, or 50.6 million, comes from tuition-based fees. And we're assuming that will grow to 51 throughout this time frame through 2028. The other third is really coming from state-based support. At this point, we're assuming that will be flat. It may go up, it may stay the same. We don't know. Best information we have, the most sensible approach is to assume that it will be flat. Operating expenses. The good thing, I spoke about the importance of forecast accuracy. The good thing is that when we look at the current view of our operating expenses for 2024, it's in line with what we had assumed back in November. So that's good. Forecast accuracy allows us to be able to make decisions financially with a far greater degree of certainty. The other thing that you'll note, and you see the percentages, is that the expense base is growing faster than the revenue base. So we know we have inflation, I've called it two types of inflation or cost increase. One is around construction activity, maintenance activity, and we know that we're experiencing higher rates of inflation in that space than we are necessarily in other spaces. But we will always be in this inflationary period. So revenue less operating expense equals structural deficit. So that's why you will see at the moment that we will be in this structural deficit zone, because our ability to raise income is only a function of the number of students we can bring in. We can't play a fee lever. In the world, we have inflation. We're always going to have inflation. That's going to outstrip at the moment our ability to grow revenue. So there will be this structural deficit. Am I worried about the structural deficit? I'd love to be in a surplus. Wouldn't anyone want to be in a surplus? But at these levels, from a structural deficit standpoint, I don't have a tremendous amount of heartburn. When you look out to 27, 26, 28, yes, the structural deficit is projected to get bigger. But honestly, I'm more focused on 24, 25, because that's what's immediately at hand. Having a view out through 28 is great because it gives us a view of the landscape and where we're heading, and we can be more proactive in terms of making decisions and doing things that will help us moderate that structural deficit position. You will see that the cost or the operating expenses in 2025 at 78 million are higher than what we have projecting for 24 at 75.5. That's a function of the investments that we've decided to make. And we'll go through that on the next chart. $3 million of investments we're going to make inside of the university. The last thing on this chart is temporary adjustments. They are, by their nature, temporary. They could be a revenue benefit, they could be an expense item. And they're temporary because they aren't always reoccurring, and we aren't guaranteed that they will always necessarily be there. If the number is positive, so it's in black font, that's good news. If it was in red font, that would be bad news. So when we look at the temporary adjustments, overall, we think that's going to be positive for us. And one of the key drivers is we started with and we continue to have a scholarship program. So we're making significant investments in scholarships for our students. And when you look at the way that the students that are having scholarships are retaining versus students that don't have a scholarship, it's about a 10-point improvement. So for each of the dollars that we're investing in terms of our scholarships, we're getting a 10-point improvement in retained students. When we started on this exercise, we kind of figured out what we thought we may need from a budget standpoint. Now we've got 2 or 3 cycles of data under our belts. We know that those forecasts were a little bit overestimated. So we've got some funds coming back to us, if you will, where we readjust what we think we need to be able to offer in terms of scholarship dollars to still deliver the results that we're experiencing today. We were funding scholarship out of the reserve balances. So when we see the reserve chart, and you'll see over time that it's coming down, it's not to be alarmed, it's because we've had the ability to take some of that reserve balance and then to invest it in scholarships. So we're making an investment today for tomorrow. And on our journey from today to tomorrow, looking at the retention, we made the right decision, and it's yielding. That's the 5-year model. So overall, we're in fairly decent shape. So if we shift gears now, and then just take a minute or two to take a look at the investments that I alluded to. So here's a chart that shows the investment decisions that we have made in 25, 26, and they are included in the budget, which is why you see the operating expenses go up, 25 over 24. And I've bucketed them here into 3 areas: investing in our people, organizational design, and university support. Investing in our people, so the budget assumes a 1.72 million increase in salaries. We're also increasing our adjunct population, and the amount that they are being remunerated for is going up as well. So there's an additional $400,000 we're investing in adjuncts to support the academic curriculum. Then we take a look at organizational design. I'm sure most of you are aware that Martin and the team have made the decision to move to a two school, two college structure. That involves some additional investment on behalf of us to make sure that that's successful. That's $340,000. And then the final bucket is what I called university support. These are predominantly people-related investments. And what I should have said on the expenses chart, when you looked at that, 85 to 87% of our cost is people. It's people cost. So when you look at the university support, we made some decisions to invest in the advancement, the athletics team, and student affairs. Advancement, this is money that we're investing to be able to have broader coverage, if you will, in terms of our reach out for gifts and for endowments through the foundation. To the extent that we can do that now and we can build up the amount of funds we have in our foundation, it gives us more flexibility going forward in terms of things that we may want to do, maybe more scholarships, maybe something else. It gives us that flexibility. So whilst we have this headroom of funding available, we're making a blended investment decision around things that will help us in the immediate term and things that will help us in the longer term. This advancement is an example of helping us in the longer term. Athletics, if you recall last time we met, or you've been reading the updates coming from Sarah's team, the number of athletes that we have at the university has grown. So we need to invest to make sure their experience is top-notch and first class, so they retain, and then they mention it to their friends and family and whatever else, and then that, again, way of driving enrollment. So we're making some fairly significant investments in the athletics department. And then the final one on student affairs, we're making investments in the student experience. So we're bringing somebody in to help us develop and reinforce ideas and programs that will drive student experience. Drive student experience, then you have an impact on retention, you improve retention, good things happen. These are the investments, but we're also making, as we mentioned earlier, the investments in the scholarship programs as well. Okay, so the next 2 charts, again, are going to be trend charts. First one looks at reserve balance, the second one looks at structural deficit. And again, we're looking at over a timeline. Blue line is the current view, red line was the view that we had back in November. So a couple of comments here. When you look at the overall trajectory of the reserve balance, yes, it has come down, but it's come down because we've made decisions because we've had healthy reserve balances that enable us to do things for the longer term good of the university. And one of those decisions was around scholarships. Again, as we said earlier, investing today for tomorrow's future. If you look at where we are predicting the reserve balances to be now compared to where we thought they would be 6 months ago or so, back in November, we have improved that reserve forecast quite significantly. Back in November, we anticipated it was going to turn negative, so our reserves would go negative in 2028. At the JPBC meeting earlier on, somebody asked the question that said, well, where's the red flag? At what point on that reserve continuum do we start to get worried? There's no real kind of green light other than I don't want to go negative. Once it goes negative, then nasty things happen, and I don't particularly like nasty things. So it's quite motivating for us not to be in that nasty zone. So 10 million is kind of the flag on the play that I would probably say. Let's make sure we stay above the 10 million. But then you say, Ian, when you look at this chart, we dip below the 10 million in 2028. Yes, we do, but again, that's a long ways out. And if you look at how that has shifted, because a couple of decisions that we have made, particularly around the amount of scholarship funding, I'll reinforce, we're not taking scholarships away. All we are doing is resetting how much we thought we needed to invest, and now we're just tailoring that down a little bit. That has a compounding impact over all of these years. The enrollment growth has a compounding impact. So those are the two hydraulics that have led us to the position that says, okay, we feel that the reserve balance will stay positive through 2028, and we'll be in fairly healthy situation, certainly in the short term. Structural deficit. So again, this one's a little bit of a complicated chart, so bear with me. All the numbers are in red. So red is negative. If they're in black, it would be positive, but they're red, they're negative. And again, similar. It's a little bit harder to tell on the lines here, but I've shown what the view was in November of 24 and what the view is now. Let's focus on 2024. And don't forget, structural deficit is income less my operating expenses. So if we go to 2024, in the dotted oval elliptical shape, the current projection for the structural deficit is just over $3 million. Back in November, we thought it was going to be over $4 million. And I've explained why it's got that much better. But that has enabled us to take the look at those investment decisions and then make some decisions about where we want to sensibly, appropriately, and affordably make some investments for the overall health and goodness of the university. And we've done that. And then when you look at the deficit beyond 24, 25, we're pretty much in line with what we were figuring back in November timeframe. So positive, absolutely would love that. We're in a deficit. I'm not overly concerned about that at this point in time. As I say, 27, 28 is a long time out. And as we said earlier, the good thing about doing a 5-year model is it gives you time to look and time to react and time to make decisions. So where do we go from here? We've got to remain fiscally responsible. You know, we need to acknowledge at the moment that expenses are growing greater than revenue. We have to stay hierarchical in terms of enrollment and retention focus. They are fundamental. And I will leave you with this. It's not a gimme by any stretch of the imagination, but history will tell me typically when we look back over time, we are more conservative when we do our forecasting than not. And typically our reserve balances and our deficits come in better than what we have forecast. I won't go through this chart. It's a bit of an eye chart. It's in the deck. You can take a look at it. It's really just looking at the key assumptions now versus November, and it just says that we're in fairly good space. So my last chart before we can open up to questions or reactions is just around capital projects. So I just wanted to share this update with you. When you take a look at the 5-year capital demand that we have demand for over $400 million of projects against a budget allocation of 100. So not a great surprise. We're having to prioritize and we're having to live within somewhat of a restricted funding environment. Also, as you mentioned earlier, we review this 5-year project on a fairly regular basis. In fact, Gary and the team and I are reviewing it with SUNY on Friday afternoon, just to take a look at where we're at. There's some things that are bubbling up to the surface that we need to have a conversation around as to whether they take priority over some other things and whether there are other ways that we can find funds to do some of those capital projects. But we are living in a resource-constrained world. It's amazing how much resource, both material and people, the Buffalo Bills' new stadium has sucked up in upstate New York. Certainly the last 12 to 18 months, it's been very, very difficult to get access to resources. We're also in a world where pricing is starting to become more challenging as well. So it's not a woe is me story, it's just a reality that we have to deal with. So that means we have to continue to be nimble, we continue to prioritize, and we continue to try to be as proactive as we can and not be on a reactive foot, as we said earlier. But there will be things that will come up that will be unforeseen, that we need to react to. Now, there are 3 projects here I just wanted to kind of make reference to. The first one is the campus-wide electrical project. I'm hoping most of you are aware of that project. We are upgrading the electrical supply across campus. This is going to impact the north side of campus, minimal impact on the south side. A lot of the work that was to do with the south side already been done. But there will be a series of rolling power outages that will start May 30th and will go through to September 17th. The May 30th one, if I remember correctly, will impact north and south. That will be it. Then all the subsequent power outages will just impact the northern side of the campus. And if you think of where commissary is and you kind of roll across the campus, that's pretty much how these power outages will occur. So there'll be, and I encourage you to go take a look at the website. If you search electrical infrastructure project on the SUNY Brockport site, it will show you the schedule of the power outages. But basically what will happen, there'll be maybe 3 or 4 buildings at a time will be upgraded. And as a building is upgraded and then the next power outage rolls on, they will not be part of that power outage. So think of it as kind of like a rolling thunder across the campus. There are a number of key buildings that have generators, so they will be able to retain power. The website has the schedule, has lots of frequently asked questions, also gives you the ability to ask any questions that you may have or seek any advice. So please be patient. We meet on a monthly basis with the team going through what we need to do. We have done the best pre-planning work that we can do. We are the whim, we are at the mercy, quite frankly, of lifting up a man cover holder, having a look in there and going, ooh, it's not quite what we expected, and that may take us a little bit longer. It may not. I don't know. We'll figure it out. But we have plans in place to be able to do that. But please be mindful, and also just make sure, as you leave, just switch things off, etc., etc. Just good housekeeping. Tuttle South. This project has been, kind of in the development stage, the planning stage, and now we're starting to get into a little bit more of the nitty-gritty. We're in the throes now of identifying the various swing spaces that need to be built out, made available as we start to roll through the renovation work in Tuttle South. This project will probably go through to about 2031. It's over a $100 million project. A lot of planning is going into this, a lot of hard work by the team, and I'm very confident we'll get there, and it will be a great addition to the campus. The last one is the Hartwell Nursing upgrade renovation. By the way, these are just 2 or 3 of a whole list of things that we're working on, but these are the kind of the most notable ones. I believe we're on schedule to be done by kind of July of 27, but there's a lot of work that's being done on this initiative. But again, it'll be a tremendous attribute to the university. And as you look at and kudos to Kathy and the team, because when you look at the enrollment numbers through the nursing programs, again, they're phenomenal. And we could probably have a Hartwell times 3, and we may still struggle to keep up with the demand. There's so much demand out there. So that will be a great attribute to the university. So I thank you for your attention. Most of you are still awake, which is positive. I thank you for the opportunity to present to you, and I'll be happy to take any questions if anybody has any questions and or comments. The materials are available, so I mean, if you've got any questions after you've had a chance to absorb this and maybe look at the materials, just reach out. There's no such thing as a silly question, and we do our utmost to answer them. Oh, Elliot. Damn, I thought I was almost off the stage.
Does anybody remember when was the last time SUNY raised tuition?
I think it's at least 5-6 years ago. It's, yeah. We were in what they called, they had a term for it. It was like a planned tuition increase, rational tuition plan, right? And so they had the rational tuition plan where they were putting forward a certain amount of money. And honestly, the tuition is still very, very affordable when you look at it across not only the private-public divide, but if you look across publics across the states, it's a very, very good tuition rate. But it's, I think, 2016, even longer, yeah. So a long, long time ago that they did that. And then we had a period of years where there was no tuition increase and no additional funding from the state. So we've had, the good news is the last 3 years we've had additional funding from the state, but we had a long gap where we weren't getting those funds at all.
So during that whole period, salaries have been going up, cost of stuff has gone up. So to the best of your knowledge or Eve's knowledge, are there any comprehensives that are not operating with a structural deficit?
I don't know. The question is, are there any comprehensives not operating with a structural deficit? I don't know the answer fully to that. What I do know is that we are in a good position relative to most of the comprehensives. It's partly how do you count a structural deficit? And I think there's a certain way in which each campus counts their budgets somewhat differently. So you're really not comparing like with like. But we are certainly aware of some campuses that are well known for their structural deficits, which are increasing. One of the things we talked about at JPBC is that, I should stand. Is that a couple of times a year, what SUNY does is they give you a snapshot in time of your cash reserves. And you can compare yourself against all the other SUNY schools. The only difficulty is it could be a day before or a day after a big expense goes out. And big expenses go out on different times for different campuses. So, you can't necessarily, take that as a full sense of the fiscal health of those institutions. However, during that period of time, what SUNY does is they want you to have cash reserves between 10 and 25% of your overall budget. Less than 10%, you go into receivership and they really look at you and they don't let you make your own decisions. More than 25%, you're at risk, I think, of somebody saying, I guess Brockport doesn't need that money, but maybe somebody else does. So you don't really want to get into that position either. You want to be in that healthy position in the middle there. But certainly, I know that there have been some UUP campaigns that have indicated in the past that all of the comprehensives have some kind of structural deficit. Ours is actually really small, and I really want to hold on to that, because the reality is there are certain changes that happen every year that mean we think our reserves are going to go down because our structural deficit is here, and we have other funding that comes in that helps us out a little bit. So I'm not not paying attention, but I'm not breathing heavy on this one. I think we're doing a pretty good job, and I think we're healthier than a lot.
Thank you, Heidi. Any other questions?
First off, thank you for a wonderful presentation. It's a complex topic, at least, and you've made it very digestible, so thank you on behalf of everybody and everyone else's efforts with keeping the lights on, at least. My question is, how are retirements and replacements configured into the 5-year model? And what options do we have, or at what time period can we entertain certain initiatives to potentially increase retirements for savings? Not that we want to get rid of our wonderful, wise folks on campus, but could you speak to those matters?
Sure. First of all, retirement's a very personal decision, so it's not something that I would influence. It's very personal. When you look at the 5-year model, and before I came here, I think there was a conscious decision that said when people were going to retire with their own volition, we would take a look at what we would do with that position. Do we rejigger the work? Do we replace, etc.? That thoughtful process still continues today. At Cabinet, we look at, I think every 2 weeks, requests for new hires. And so we look at those and we make sure that they're in the, they're the appropriate things to do. With regard to the 5-year model, there is assumption around what the retirement eligible savings could be. And that number is declining. And it's declining because the population of people that are retirement eligible is declining. I think if I remember correctly, if I look at the length of service in the 0 to 11 years or 0 to 10 years, it's about 60% of the population. And then up to 20 years, I think, is another 20% of the population. Round numbers, I could be off a point or two. So basically 80% of the population have been here for 20 years or less. And if you go back over time, it wasn't as great as that. So people are just naturally, because they've made the decision personally, they want to retire, which we respect, that population of people is reducing. So hopefully that answers your question. Okay, so again, I thank you for your attention. I wish you a great Thursday, a fantastic weekend, because tomorrow is Friday, and take care. Thank you, everyone.